Hello, ladies and gentlemen, and welcome back. Well, we've just experienced one of those meltdown weeks. Stocks were down, cryptos were down, and of course, commodities were getting destroyed. Things like oil dropped over 5% on the day, but stocks did recover near the end. And why is this? Well, it's a mixture of extreme points, gap fills, and also probably excess. That is, markets have actually sold off so aggressively there's a potential for a small bounce. What happens over the next week is now going to be so pivotal. New lows equals more pain to come. Will we hit 3,500? Will we go down all the way to 3,200 over the next coming months? Well, what happens over here is going to be pivotal. Let's talk about it right now, including a reading we have not seen in over 40 years. Bonds markets are very sick. Well, welcome back everybody to the weekly show wrap up where we talk about everything ahead for the stocks, commodities, and cryptos of the world. Stick around because we'll be going through macro over 40 years of economic data. We've never seen this before in terms of yield inversion. And of course, we'll jump into the charts and look at the key levels that you need to be watching for the week ahead. Leading indicators are contracting. Basically, we have here a whole bunch of economic data jumping or being bundled together to show us whether there is a recession or at least some kind of further economic sickness coming. We have this over 40 years plus, and what you'll notice is that when you look at the readings, scary things come out because we saw these types of readings ahead of very large falls back in 2000, 2001, and of course the GFC 2008. Even back in other periods, these have often led to serious, significant falls over the next 6 to 12 months. Take a look at these stats. The next 1 to 2 weeks sometimes were quite positive actually, but it was what happened a month, 2 months, up to 12 months later that was scary. The economic factors are starting to paint a picture that is very bleak. When we saw these types of indications, we were either usually in a recession already or we were just about to enter one. You'll see and you'll notice that we got the reading actually from this particular signal a little while ago. So it's showing us that there's a recession very, very likely on the horizon. Of course, bonds have already said that. Most people, already believe we're in a recession. They change the wording on it all the time. So who the hell knows what's happening there? But this is where things get crazy. 50% of yields inversion. When that occurs, it's always been correct. On top of that, we also have this statistic, and this is where things get scary, guys. The deepest inversion in 4 decades, in 40 years, the deepest inversion. Look at the 2008 crisis, look at the 2000 crisis, and the inversion on the bond yields right now. This is showing us that markets are actually freaked out, but what we're not seeing that represent in is the VIX or necessarily that much even in bonds yet. Yes, bonds have fallen off a lot, but believe me, this is crazy. When you think about this inversion reading, if the markets are correct, they're calling for a lot lower and a lot more unfortunate pain to come. When we saw these types of 50% yield inversions, we already know, here's a stat that we shared on the previous video showing us all of the different markets and what they did 12 months later. Again, it stacks very negatively towards certain markets over at least the short to medium term. It's not necessarily a very positive sign. Of course, over here, the macro model also showed weakness over the next 3 to 6 months. So again, it's just weakness, weakness, weakness. All of those positive signs, the breadth, the thrust, it seems to be gone. Remember, that's what was happening only a month or two ago. Now we're back down here during the double dip. Things are looking bad. And retail traders out there and AAII sentiment reports are showing us that people are super negative. This is probably the most negative reading I've ever seen from these particular surveys. 60.9% of people were bearish, and this was taken as of Tuesday this week. In fact, they said over here, if you want to follow them on Twitter, that the survey's history, this is one of the 5 highest bearish sentiment readings in the survey's history, and the bullish sentiment ranks amongst the 20 lowest readings. 17.7% bullish, 21.4% neutral, and a huge amount of bears. Now, often when we got these huge bear indications, even though we used it as a contrary indicator and of course look towards buy zones, there was a little bit more dip to come. And that's what a few people have sent me in their reports. They've said there's usually going to be a little bit more dip after such a big, huge negative reading of 60% plus. Now, for anyone that's been following yield inversion, following what is the story this year, which is basically just interest rates versus, of course, inflation, what we're getting here is we're getting a super reading between 8 months from the last hike to the first rate cut. The market has now priced that in, as in the bonds market. I'll show you that very, very soon. We'll take a look at it together. Over here, we've still got the weakest month of the year. As we talked about, September, the back end of September is living up to its name. Usually where that weakness comes in heavily, the back end of September. Here's midterm election years. Here's all other years. We've talked about this chart many, many times. Will we get the bull run in October? Time will tell. October 16th, put it in your diary. I believe that's the time that the CCP will vote on a whole bunch of stuff in China. That could be a real pivot if something happens there. It could be a fizzer, could be a pivot. You need to pay attention, and not enough people are talking about it. Bear markets over time. Pause the video if you're interested in looking at that stat. Of course, we've already seen the correlation now. We're double dipped as per the 62 reading, and we are most correlated right now with, of course, 2008. Whereas if we make a new low, will we get one of these shockwave readings? You know, the scary thing is when we took that reading before, which was those economic indicators, remember the GFC, we were around here when we got that reading. We just got the reading and we're literally at the exact same point. I hope it isn't that, but certainly correlating at this stage towards that being the biggest kind of similarity with over market petitions. Here's the midterm election stats. As you can see here, since 1962, generally speaking, it's been negative into them and then bullish out of them. Pause the video if you're interested in this bit. And just before we get into the charts, I'd like to quickly thank the sponsor of today's video, which is Tiger Brokers. So just before we jumped into the charts, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. And I thought we'd look at this again, the market cap sizing and what's happened over the last 10 days. A sea of red. But look, this is where traders often misinterpret what they're looking for. You should be always loading these types of heat maps up during the day and seeing where the money moved. Because during the last day, it would look like everything was red. But funnily enough, if I was in home improvement retail, yes, I would have been green on that session in terms of buyers. Yes, everything was bad. Everything was really red. You can see gas was the one that was hit the most on the Friday session. But what I particularly like doing is going over here to industry as well and seeing all of these different sectors and ideas. If I want to buy copper stocks, they've got a bunch of the big copper stocks in here and you can see them all. If you want to buy airlines, you don't know all the companies, here's some of all the US airline companies. And you can do this for different markets around the world. Hong Kong, Singapore, AU, Australia, all of these can be done inside the Tiger Brokers platform. And on top of that, of course, you've been watching our videos for a while. They have a whole bunch of other special features and they're constantly adding to the platform. So if you're interested in it, definitely check them out. Do remember, for the Australian audience out there, an extra 30 zip stock on top of the 20 zip stock just for FX Evolution community members for Australia, as long as you fund with over 1 cent. I did just want to let you know, I believe they manually add the next 30, so you'll get the 20 and they'll add the 30 over the next week. That's up to the 30th of September, so don't delay if you're interested in, of course, that special offer. Okay, well, let's get back into the charts here and talk about everything that's got to do with the VIX, the volatility in general on markets, and the key levels we need to be watching. 29.91, neither a really high VIX rating nor a really low one. Remember, 20 allows us to see greed and 35 plus allows us to see like a peaking of fear. And most markets will generally end with a very high VIX reading. And that's what we've tended to see in the past, capitulation and fear. It's my belief we won't really get a 35 plus break, of course, without a significant drop below the lows on the SP 500. And once that happens, you'll see the VIX get past 35 if it does occur. So definitely watch that. But here's the story I believe most people are missing. And of course, we've been talking about it for a while. The bonds market is telling us a lot about yields and what the market believes is going to happen to inflation right now. The 2-year is sitting at 4.2%. Let's just quickly bring up the 2-year actually. Here it is, 4.2%. That's up heavily, especially over the last 1 and a bit months. So it's basically showing us that we're going to be in 2 years' time at a 4.2% interest rate reading. Now, what's more important is when we think about what's happening in between that, April 2023, almost now 4.7%. And this is where things get super scary. September 2023, almost the exact same reading. So this is meaning that the market expects not only rates to go up very heavily now, an extra 25 basis points to 4.75, but then they expect those to not be cut, which was the general expectation, is the cut would come somewhere around April of 2023 to maybe June. Now the expectation is there's no cut till December of 2023. And this is going to send shockwaves through a lot of your friends, a lot of your family members that truly have absolutely no idea that this is coming. If you ask them, I bet you, if you're there during a barbecue or you're catching up with family and you ask them, hey, do you think interest rates are going to be at 4.75 next year in the US? They'll all say, nah, come on, man. No, they just got put up. They're not going to do it anymore. They have no idea. They really don't. This is the pain that will happen. It will kill demand and it will most likely, to a degree, curb inflation. But what damage it does is to the companies, to the economy behind it, is really what we now discuss in these markets. High yield bonds, new low, we reported on it, continued on its way down. This is a mixture of realistically yields going up and of course the risk that's in these markets right now, and the bonds market hates it. Some of my lead bond indicators still haven't really cracked new lows in a serious case, so they're not really leading, I guess. But when you're looking at just HYG, when you're looking at tips, they're all showing you the same story. TLT, a lot of people have been buying treasuries recently. Treasuries were up on this day. They haven't quite hit into what I would like to see as a demand zone, and we don't necessarily know we've peaked off even in those bond yields. 4.75 is high. I've theorized that we could get even between 5 to 5.5, and I think that's probably a topping level for current yields and the expectations. Let's have a look at the dollar index. Look at this. It hits one of the weekly closes. Will we see a DXY, a US dollar at 120 handle this year? That is a previous peak. Like if we go through a monthly, you can see here the closures of these October lows. That's where we closed this week. And then we've got those super highs. If we break through again, we could see extreme movement here on the DXY. And if we do see this extreme movement and it continues to pump up over the next couple of weeks, somewhere around here is where you're going to correlate this back to the stock market should it happen and say this could be a really big demand zone for the stock market. That'll be a huge pump on the dollar index, and it's super far away from a lot of its leading indicators. So if you look up a moving average, and we usually use these on the channel, so I'll just add one to this chart so you guys can see it. Let's just quickly add here a 20 moving average, and we'll make it red because we like fast cars, Ferraris and stuff. And look at how far away it is. Now, it's not unheard of to move this far away, but oftentimes once it moves this far away, it stabilizes at key zones. Will that stabilization be exactly where it is here, or the real possibility of a 120? I think you've got to set alerts for some of these levels, guys. They are pivotal zones for the US dollar moving forward. So with strong US dollar, that means weakness across so many things paired to it. We saw gold weaken. It's down underneath that 1660. This now opens gold to serious drops. Will it go 1569? Will it go 1461? It should synergize with that DXY if dollar continues to strengthen, and of course gold will continue to weaken. We take a look here at the next couple of days though. What happens then? Well, I've got some alerts here, as you can see on this chart, and these alerts are set around ideas of if markets come back up, where short potentials are, previous supply just around here, previous daily closes, a whole bunch of things that are sitting on this level could open up to further shorting from gold. And if gold does have the strength, if everything does reverse, you've got to be open to that idea. A closure above here, a significant level now, you can tell that it's big market structure, 1691, that will open the buyers back in to be committed. I wouldn't be a buyer here on gold. I just don't think, I think it's in the middle of nowhere. It looks super weak. The chart's showing you weakness. You have to be open to the idea to flick it like any trader does in terms of flick your opinion. but we do not have any reasons to do that at this stage. We've gotten through the big low. Of course, all that previous strength and previous weakness, we definitely thought over here, of course, we were going to go bullish on gold, but what happened? Yield went out of control. I've told you guys many times, gold hates high yield. It hates it. Let's have a look at oil. ZOM got absolutely smoked on the Friday session, destroyed. It left a huge gap behind. A lot of stocks left gaps behind. Maybe they go to fill these early next week. We'll talk about that more in the SP 500, but I wanted to just show you this weakness, this horrible weakness through oil. Oil, new low here. US oil, UK oil, they're all bad. I've still got the midterm in terms of the mid cycle to get down to the 65. That's my aim, 65, 66 on oil over the next coming months, 6 months, that kind of period. I've said this now ever since July and June. I went crazy about oil. And it is working, but this is just, of course, counter to a lot of people's logic. Let's have a look at Tesla. It fell through. Interestingly, very little bounce with the rest of the market. People will be now looking at this as a double top. They'll be looking for a closure below 266. This is really down to the stock market more than Tesla at this stage. So we'll look at that in a moment. If you take that distance, you'll notice it hits those bottoms, those 217 bottoms. Be very careful in Tesla right now. It's at pivotal, very careful levels. And I want to now talk about every stock in these markets, the big ones. Look at this. Technology. It literally swung the low and just instantly kind of bought slightly back up near the end of the session. It could be this was the low. It really could. I doubt it, but it could be. And it bounced through. And this is where we're going to see a bounce. And there's a few pivotal areas where shorters are going to come in. If we get a new low on XLK, where do we go? Is it down here? 110. Ooh, I think it could be. Let's have a look at a percentage of how much more percentage drop that would be. Around 11%. And hear me out here because we're going to go through quite a lot of stocks. AMD, absolute horrific looking chart. You can't tell me this chart looks good. It looks like crap. And when you put this on a chart, look, it's terrible. It's gone through. It's already busted the low, found buyers. So this is probably a real break. This is just stock one. Big volume, big sell-off. Obviously, we're looking at 60s or 58s into even 50 for this type of stock. Google, through the low, gap fill potential here. I think it actually may have, it did. It filled the top of the gap, but not the actual closure gap. We'll talk more about that soon. But Google is underneath. Does this now, even if there's rallies, does this now signal we go back into the 80s? This is what a lot of investors and traders alike will be looking for. Microsoft busted the low here. A level I've been crapping on about for a while, 225, a huge zone, trend line, resistances. Microsoft will probably hold better than some stocks because it's a good quality one. But still, from this point down to here, you're looking at around 7%. Google was even more. Meta, 2020 lows. Haven't got there yet. But do we then move to 123, which is the 2018 low? Geez, that'd be brutal. But it is what is possible. And then we got to the last exhibit. Before we look through the breakout in other emerging markets that could be leading the US market. What is Apple doing? Apple is so ridiculously strong. This stock, it can't be stopped. And I think that's just because there's so many shorts on it. When there's so much shorts on some stock, we've seen this with Tesla, we've seen this with other stocks, they tend to hold up better. If Apple fails, watch out down below. Could be an alert for the week ahead because seriously, this is a level that now, if it breaks, well, this is the only stock really holding the Nasdaq and tech sectors up. Look at this. This is the DAX, the German market. If it's leading, which it has before, it's showing us pain to come. And while we may see some bouncing, which we'll talk about soon, it looks really, really bad. It's swung all of these previous wick lows. It's coming down with a series of lower highs. So we've got lower highs, lower highs, lower highs everywhere. That's not what you want to see. It shows weakening of the market. And the next stop for something like this, which we've theorized for a while, is 11,500. So there's a lot not to like about these closures here coming into the weekend. Let's now talk about the US market because most of you are interested in these levels. So I did think that we would probably hold this zone. That is these wicks would be held on the Nas. We ended up closing there, but we went lower first. And I'll explain why in a second, but we went lower first. I think it's best to talk about the S&P 500 and then correlate it back to the Nasdaq this week. So here is the S&P 500. This was the gap that was left behind by the island reversal that was here in the past. Now notice that these were basically equal lows. This is going to be a very, very important level to set your alerts for. We hit the gap close and there were two opportunities. Some people use it from the wick. Some people use it from the body or the close. I'm going to show you this right now. So let's go down here to the 2-hour chart just so you can see where the previous market had closed. So it closed here and it came out of the gate super strong. So it came down to this level. Here we had a bunch of wicks and huge demand previously, huge spiky volume, all sorts of things going on. And the market held the zone. It created a bullish hammer and it bounced. Look at the gap that's left behind. So we've got one that's left here. We've got, of course, huge amounts up above. But this is where the market decided to put its stand in. It didn't go to a new low like a lot of people probably would have expected. It held this area which was previously bought heavily. Will we now do something like this? Or a little bit higher and then down? Shorters are going to be present in many locations. Let's talk about the locations. First up, the previous little bit of demand area, which could become, of course, resistance or supply, or the big kahuna one now that sits at 38.62. I'll jump into the smaller timeframes. Let's have a look at the 1 hour and understand this structure a little bit better. So basically the market has come down and it's come down fairly aggressively recently, not leaving much behind, which makes it very difficult for a trader that trades supply demand, even support resistance or any kind of market structure really in general. These levels seem to hold most of the orders. 38.62, I could see something like this occur, or we see a jump up to this area, 37 kind of 60, and this becomes a little bit of a sell-off as well. So I think that either of these hold basically bear busts in them, where bears will try to come in and pressure the market. And I could realistically see the market at least trying to fill back to this gap level, where it closed at 37.50-ish, it comes back up to 37.60, closes at least that gap that it's left behind, and then maybe has some sell-off in it. Now, will that sell-off take the new low? I'm not sure yet. We'll look at the options in just a few moments. There's just so much to discuss here today. But yeah, these two zones, I believe, hold the keys for the shorters. For the longers, for the people that are going, well, where do I even consider buying this market? Again, if we go to moving averages, you could argue right now is the time. You could make a very big argument. The stats would say that in the past, whenever we've seen over 50% fib retracement back to the previous kind of highs, and I'll just quickly show you what that looks like. So we're talking about a 50% fib retracement from here to here, which it did do when it went through this zone. That was over 50% of the whole move. That usually meant we weren't getting a new low. We actually haven't seen a new low yet. But in my experience, look, things like history are willing and ready to be broken. We generally come down in the market to a 200 SMA. In almost every other market, we've done that. We haven't quite tapped that level yet. That level sits just on a new low, just underneath 3,600. It sits at 35.88. That could be the extreme low that some people are looking for. Underneath that, we have obviously a 3,500 previous high, which is a big resistance, a key level. And then we have the one that everyone will be talking about should it happen, a 3250, 3200. If the market comes down aggressively into here over the next months, this will be where I believe big kahuna whales will sit. And they'll be pretty whaley around this area. I'm fairly confident there'll be whales there. Obviously, nothing is guaranteed. It just makes sense on the charts if that was to occur. So we're at a very pivotal point. We've got two potential sell zones. We have absolutely no reason to say that this is fully bullish yet. We'd need to see at least above 39.20 to 39.60 for us to actually see this being bullish and then see pullback after that. And we are nowhere near that at this stage. 39. Yeah, those two levels will be the key ones. I'm pretty sure. I'll just quickly double check those for you guys. Yeah, this one here and this one here. These hold the biggest keys. So we'll, of course, keep you updated throughout the week on that. Let's have a look at options, 23rd. We see here the 360 puts didn't get paid, 365s, and we ended up basically on the 370 puts. Let's look for the week ahead, the 30th. What's going on there? Way more options. First up, look at the options interest. Way higher. This week was always going to be scary because there just weren't that many options in the system. Look at this, 350 puts. Ooh, that looks like a put wall to me at 350. 360 also quite strong, and 370 relatively strong. So it's three big put areas, the biggest one being the 350 here and the 360. So if the market does end up making a low, remember we talked about those extreme zones, watch these levels and how the market interacts with them. Either subscribe to this channel, watch them, set alerts, make sure you're aware of it. It's going to be super important. Bitcoin, it's doing nothing. It's sitting within those two levels. We've talked about shorters being here. And if you get underneath 17.5, watch out down below. It could get brutal fast. 9 to 12,000 is what I'm thinking if it gets underneath 17.5 over that next period. Come and follow us over at FX Evolution on Twitter. Of course, join our Discord community, whether it's the public one, and share concepts with over 10,000 members. Or, of course, join our private community if you're interested in our our private streams. 7-day free trial is what I was meant to say. And yeah, we do private streams, do a newsletter, all of that good stuff. For the week ahead, 10 a.m. CB Consumer Confidence we have, which is on Tuesday 27th. Then we scroll down here and we see the core PCE price index, 8:30 a.m. Friday, September 30th. So it's not a week of huge news. It's a week that is allowed to be technical and crazy. And I think it's going to open up some possibilities towards some pretty good trades. Congrats to people that have, of course, taken bearish positions into this point. For me, I thought 37.50 was certainly a very good area to be cutting some of those positions down and then waiting for the next move. But you've got to just live with your decisions. If you were shorting into that zone, you take it off and you think, oh, I could have taken more. Remember, trading is about replication, and that's the most important thing. Big thank you as well to Tiger Brokers, who of course have sponsored today's video. If you're interested in getting some of their special offers, click the links down in the description below. Remember, Australian viewers get an extra 50 zip stocks. That's 30 on top of the normal 20 they offer for FX Evolution community only from Australia. You will have to wait a few days because they'll manually add the extra 30 just to clear up any confusion. And of course, subscribe and smash the like if you enjoyed the video. Thanks so much, guys. We'll see you in the next one.